Module 7, Tax Planning and Compliance for Entrepreneurs.
Welcome back to Financial Planning for Entrepreneurs. I'm Andrew, and in this module, we're diving into tax planning and compliance, a critical part of running a successful business. Taxes can be overwhelming, but with the right knowledge and strategies, you can minimize your tax burden while staying compliant with the law. In this module, we'll explore your tax obligations as a small business owner, uncover deductions and credits you should know, discuss how to work effectively with accountants or tax professionals, and ensure you stay compliant with local and federal regulations. Let's get started. Understanding tax obligations for small businesses. Understanding your tax obligations is the first step toward effective tax planning. As a small business owner, you may be responsible for several types of taxes. 1. Income tax, taxes on your business profits. 2. Payroll tax. If you have employees, you'll need to withhold and pay payroll taxes. 3. Sales tax. Depending on your location and industry, you may need to collect and remit sales tax. 4. Self-employment tax. If you're a sole proprietor, you'll pay Social Security and Medicare taxes. Each tax type has its own deadlines and reporting requirements. Staying informed about these obligations ensures you avoid penalties and keep your business running smoothly. Deductions and credits you should know. Deductions and credits are powerful tools that can significantly reduce your tax bill. Here are some key ones you should know. 1. Home office deduction. If you use part of your home exclusively for business, you may qualify for this deduction. 2. Business expenses. Deduct costs like supplies, travel, marketing, and equipment. 3. Health insurance premiums. Self-employed individuals can often deduct health insurance costs. 4. Tax credits. Look into credits like the Small Business Healthcare Tax Credit or Energy Efficiency Credits. Pro tip: keep detailed records of all expenses throughout the year. This makes it easier to claim deductions and credits when tax season arrives. Working with accountants or tax professionals. Working with an accountant or tax professional can save you time, money, and stress. These experts help you navigate complex tax laws and ensure you're maximizing your savings. Here's how to make the most of this partnership. 1. Choose the right professional. Look for someone with experience in your industry or business structure. 2. Communicate regularly. Share updates about your business, like changes in revenue or expenses. 3. Ask questions. Don't hesitate to clarify anything you don't understand. This is your money, after all. 4. Plan ahead. Work with them throughout the year, not just during tax season, to stay proactive. While hiring a professional comes with a cost, their expertise often pays for itself through better tax strategies and peace of mind. Staying compliant with local and federal regulations. Staying compliant with local and federal regulations is essential to avoid penalties and maintain your business's reputation. Here's how to stay on track. 1. File on time. Missing deadlines can result in fines or interest charges. Use calendar reminders or accounting software to stay organized. 2. Understand your jurisdiction. Tax rules vary by state, county, and city. Make sure you're meeting all local requirements. 3. Keep accurate records. Maintain receipts, invoices, and financial statements in case of audits. 4. Stay updated. Tax laws and regulations change frequently. Subscribe to newsletters or consult professionals to stay informed. Compliance isn't just about avoiding trouble. It's about building trust with customers, partners, and regulators. Great job completing Module 7. You now understand your tax obligations as a small business owner, learned about valuable deductions and credits, explored how to work with accountants or tax professionals, and discovered how to stay compliant with local and federal regulations. In the next module, we'll focus on building resilience through emergency planning, a crucial step in preparing your business for unexpected challenges.
Module 8, Building Resilience Through Emergency Planning.
In this module, we're focusing on building resilience through emergency planning, a crucial step in preparing your business for unexpected challenges. No matter how well you plan, emergencies and economic downturns can happen. But with the right strategies in place, you can weather these storms and emerge stronger. In this module, we'll explore how to prepare for economic downturns, create an emergency fund, develop contingency plans, and stress test your business model. Let's dive in. Preparing for economic downturns. Economic downturns are unpredictable, but preparing for them can help your business survive and even thrive during tough times. Here's how to get ready. 1. Monitor economic indicators. Keep an eye on trends like inflation, unemployment rates, and consumer spending. 2. Reduce unnecessary expenses. Trim costs that don't directly contribute to revenue generation. 3. Diversify income streams. Relying on multiple sources of income reduces risk during market shifts. 4. Strengthen customer relationships. Loyal customers are more likely to stick with you during challenging times. By staying proactive, you can position your business to handle economic uncertainty with confidence. Creating an emergency fund for your business. Just like individuals need an emergency fund, businesses do too. An emergency fund provides a financial cushion when unexpected expenses or revenue dips occur. Here's how to create one. 1. Set a target amount. Aim for at least 3 to 6 months' worth of operating expenses. 2. Start small. Even setting aside a small percentage of profits each month adds up over time. 3. Keep it accessible. Store the funds in a high-yield savings account or other liquid assets. 4. Use it wisely. Reserve the fund only for true emergencies, like equipment breakdowns or sudden drops in revenue. An emergency fund gives you peace of mind and the flexibility to navigate challenges without derailing your business. Developing contingency plans for challenges. A contingency plan is your roadmap for handling unexpected challenges. It ensures you're prepared to act quickly and effectively when crises arise. Here's how to develop one. 1. Identify potential risks. Consider scenarios like supply chain disruptions, natural disasters, or losing key team members. 2. Outline response steps. Define what actions to take, who's responsible, and what resources are needed. 3. Communicate with your team. Ensure everyone knows their role in executing the plan. 4. Review and update regularly. As your business evolves, so should your contingency plans. Having a plan in place minimizes panic and helps you respond strategically during emergencies. Stress testing your business model. Stress testing your business model involves evaluating how it performs under pressure. This process helps you identify vulnerabilities and strengthen your operations. Here's how to stress test effectively. 1. Simulate worst-case scenarios. For example, what happens if sales drop by 50%, or if a key supplier goes out of business? 2. Analyze cash flow. Can your business survive temporary revenue shortages? 3. Test operational flexibility. Are your processes adaptable enough to handle disruptions? 4. Seek feedback. Consult mentors, advisors, or industry peers for insights into potential weaknesses. By stress testing, you'll uncover areas for improvement and build a more resilient business model. Congratulations on completing Module 8, an entire course. You now know how to prepare for economic downturns, create an emergency fund, develop contingency plans, and stress test your business model. Building resilience isn't just about surviving challenges. It's about thriving despite them. With these strategies in place, you're better equipped to navigate uncertainty and grow your business with confidence.
Module 9. Monitoring and adjusting your financial strategy.
In this final module, we're diving into monitoring and adjusting your financial strategy, a critical step in ensuring your business stays on track for long-term success. Even the best plans need regular check-ins and adjustments. In this module, we'll explore how to set up key performance indicators, KPIs, review financial statements regularly, identify areas for improvement, and adapt your strategy based on data insights. Let's get started. Setting up key performance indicators, KPIs. Key performance indicators, or KPIs, are the metrics that help you measure your business's progress towards goals. They provide a clear picture of what's working and what's not. Here's how to set up effective KPIs. 1. Align with goals. Choose KPIs that directly reflect your business objectives, like revenue growth, profit margins, or customer acquisition costs. 2. Keep it simple. Focus on a few key metrics rather than overwhelming yourself with too many. 3. Make them measurable. Ensure your KPIs can be tracked with real numbers, like monthly sales or website traffic. 4. Review regularly. Set aside time each month to analyze your KPIs and adjust as needed. Examples of common KPIs include gross profit margin, customer lifetime value, burn rate for startups, inventory turnover. By tracking the right KPIs, you'll have a clear roadmap for success. Regularly reviewing financial statements. Regularly reviewing your financial statements is essential for staying informed about your business's health. These documents provide a snapshot of your financial performance and highlight areas that need attention. Here's what to focus on. 1. Income statement shows your revenue, expenses, and net profit over a specific period. 2. Balance sheet provides an overview of your assets, liabilities, and equity at a given time. 3. Cash flow statement tracks the movement of cash in and out of your business. Pro tip: schedule monthly reviews to spot trends early. For example, if expenses are rising faster than revenue, it's time to investigate and make adjustments. Use tools like QuickBooks, Xero, or even Excel to organize and analyze your financial data efficiently. Identifying areas for improvement. Once you've reviewed your KPIs and financial statements, it's time to identify areas for improvement. This step is about turning data into action. Here's how to approach it. 1. Look for patterns. Are certain months consistently less profitable? Is one product line underperforming? 2. Compare against benchmarks. How does your performance stack up against industry standards? 3. Ask questions. Why are costs increasing? Why are customers leaving? Dig deeper to uncover root causes. 4. Prioritize changes. Focus on the areas that will have the biggest impact on your business. For example, if your marketing spend isn't generating enough leads, consider reallocating funds to more effective channels. Small improvements can add up to big results over time. Adapting your strategy based on data insights. The final step is adapting your strategy based on the insights you've gathered. Data-driven decisions are key to staying competitive and achieving your goals. Here's how to implement changes effectively. 1. Set clear action steps. Define exactly what needs to change and who's responsible for making it happen. 2. Test and iterate. Try small adjustments first to see how they impact your KPIs before scaling up. 3. Communicate with your team. Ensure everyone understands the changes and their role in executing them. 4. Monitor results. Track the impact of your adjustments and refine further as needed. Remember, flexibility is a strength. The ability to adapt ensures your business remains resilient in a constantly evolving market. Congratulations on completing Module 9 and the entire course. You now know how to set up KPIs, review financial statements, identify areas for improvement, and adapt your strategy based on data insights. Monitoring and adjusting your financial strategy isn't just about fixing problems. It's about continuously optimizing your business for growth and success. With these skills, you're well equipped to lead your business confidently into the future. Thank you for joining me on this journey through financial planning for entrepreneurs. Remember, financial planning is an ongoing process. Stay curious, stay disciplined, and keep learning. I believe in your potential to build a thriving, resilient business. Until next time, take care.